Well, hello there, everyone. It is Tuesday, May the 2nd, year 2022. Hopefully, you're doing outstanding. As you know, I'm an investor. I'm not a financial advisor, not a CPA, an attorney, and I look at all various ways to invest. And I've been quite successful in my life once I learned how to invest in real estate. Yeah, because real estate is the best way to create wealth. But I'm going to talk about an alternative investment. And if you know anything about this, please share it in the comments because I'm still learning about this, okay? But I had a long conversation with a guy today on investing in life insurance. So I'm gonna try to cover, I wrote notes down when I was talking to him, so I'm gonna try to cover a lot of it and be semi-brief, but it might get a little long. But the last way I'm gonna talk about is how to invest with a decent return with $0 out of pocket. $0 out of pocket. Okay, to get started here, he told me there's 5 types of insurance that you can potentially invest in. I got a rough throat today for some reason. So I just drinking water. And I scribbled and I don't have everything accurate, so don't hold me to it. This, okay? Might not be 100% accurate, but it'll be very close from my interpretation of what this gentleman told me. There's whole life insurance, indexed universal life insurance, variable life insurance, standard universal life insurance, and term insurance. And he basically told me to cross off variable life insurance and standard universal life insurance because they're no longer working in regards to investing. Term life insurance is the one that a lot of people are knowledgeable about. It's you get life insurance. Oh, maybe it's, as an example, it's $100,000, and you get it. You pay annually. You pay monthly for an annual premium. And I think when I've had it in the past, it's a fixed rate premium. I think it may go up depending on your age. When you hit 30, 35, 40, 45, etc. It may change, but that way it's the cheapest death benefit. I had it through, I think it was USAA. No, I had it through ASMBA. I was in the military. But I didn't know this for all those years of paying it. But as I was approaching 50, they wrote me a letter and said they've changed their policy or blah, blah, blah. And at age 50, they're canceling my term life insurance. They're no longer insuring older people. So ever since then, I've been without an additional term life insurance, which is fine with me. All right. But he gave me an example of term life insurance. You got to qualify for it. It's a shorter term investment. It's the cheapest. But you got to qualify, and I don't know the qualifications, but you get like a 20-year term. All these are long games, long play games, okay? 20-year term, you pay your monthly premiums, and he gave me an example. If you're 35 years old, you pay $35 a month. It's for a $500,000 policy, so $500,000. And at the end of 20 years, you get all of your premiums back, okay? So with that one, in a nutshell, if you're young, say you're 25, you get a 20-year term, $500,000. You pay let's just say it's $35 a month, and at the end of the 20 years, it stops, the policy stops, but you get all your premiums back, okay? I'm not interested in that myself. He talked about whole life insurance, and I think the other one's indexed universal life insurance. For either of those, you would need a physical, all right? So you got to get a physical. I got to adjust up this camera because it seems like if I'm sitting normally, I got a lot of space up here, and you might, at times, if I lean in, I get cut off here, so I need to figure this camera out. It's different, okay? So anyway, just bear with me. All right, he stressed to me, anytime you invest in life insurance, it's the long game, 10 to 15 to 20 years, okay? Long game. He said, whole life or index universal, the monthly premiums could be between $350 and $500 a month. He says what some of his clients do is they will then go with term insurance, it's cheaper, and then if they can afford the $350 to $500 a month, they go with term insurance, and then what the difference is, they invest that difference in a variety of different ways, okay? All right, that still doesn't interest me. One benefit of life insurance, it's tax-free. If you die and you have heirs, it's tax-free at death, all right? And there's other potential death benefits or benefits from different life insurance policies, all right? Then he also said when you have standard, when you pay it, you have standard ways of paying it. You pay every month, or you pay a lump sum. You pay it all right now, okay? Whatever the premium is, you pay it all right now, all right? He says there's such thing called a 1035 exchange. Real estate, you have a 1031 exchange. With insurance, you have a 1035 exchange. And the third way he talked about was premium finance life insurance. And that's the one that's interested to me. This is the one that potentially is $0 down. It's not complicated per se, but it's complicated just a bit. So I will try to explain it to you. Again, let me know if you've heard of this. Let me know if you know of anyone who's done this. Let me know what you think. Let me know if you might be interested, okay? Because I'm curious about all kinds of investing. It doesn't mean I'm going to do this, but I'm intrigued by this one. I may give it a try because it's $0 out of pocket. That intrigues me. If I can make money with no money, I like that, okay? All right, so premium life insurance, and he's got premium finance life insurance. He's going to email me the proper steps to do this. So I may be slightly out of order of how I'm going to explain this, okay? But basically, you get a life insurance policy. It's some kind of whole life insurance policy. And let's just say for easy math, you get a $100,000 life insurance policy, okay? You go to a bank, and he told me the banks you would use are the big banks like Chase, AIG, Fannie Mae banks. They got a list of big banks that do this sort of thing. You go to a bank, you get a loan from the bank to pay the full premium of your whole life insurance policy. All right. He says there are banks that do this. It's whatever they call it. I didn't write it down. It's a loan for life insurance policy, you know. And we said what they do is they charge, it's an interest-only loan. And I don't know all the details of the loan, okay? And I haven't done the math to see how this all works out. But he said it's an interest-only loan. You get, say it's $100,000. You pay 3.5% interest, all right? So you pay 3.5% interest. The life insurance then is a dividend-paying life insurance. And I know whole life insurance can pay dividends. I think early in my Navy days, I think I had a whole life insurance policy and it paid me some kind of dividend, but then I gave it up because I found mutual funds and stocks or whatever I did. That was a long time ago. All right, so dividend paying life insurance, and he says they're paying 6 to 8% interest. It's a dividend. So let's assume you're getting paid 6%. You get this loan from the bank, $100,000 loan, interest only. They pay the annual premium, the whole premium, whatever the premium is for that $100,000 policy, and then you pay them 3.5%, but you get 6%. So you're making 2.5% interest. He said, basically, you can do this with $0 out of pocket. You can get the life insurance policy started. You go to the bank. You don't pay any money out of pocket, and you can make 2.5%. If you're not paying nothing out of pocket, you can get 2.5%. That's not bad, okay? However, and there's greater return I'm going to talk about in just a minute, potentially up to 20% or so, okay? But we didn't talk about this, but the one thing is if you're an investor and you take a loan out from a bank, that goes against your debt income ratio, okay? So if you're trying to get mortgages, now you have higher debt, I assume. I don't know exactly how that all works, but you have higher debt. All right, so that may hurt you in potentially getting mortgages. In my case, I'm no longer getting mortgages from a bank, a conventional 30-year mortgage. I'm going with non-QM lenders. You know, they look at the asset only, they don't look at me. All right, so I don't think this would impact that. All right, I don't think. I'll look into it further. All right, but he said to take this further, you're getting, say, that 2.5%, I guess potentially 4.5% if you got the 8% dividend. And you pay the bank loan of 3.5%. So that could be a 4.5%, 2.5% to 4.5%. But then he says what they can do is set up a collateral account. The bank has paid the life insurance policy in full, the premiums. Whatever the premiums are, they paid it in full. So whole life insurance has a cash value. So he says what they do is they set up a collateral account, and depends on who the life insurance company is, you can normally get access to 80 to 100% of the cash value. All right, 80 to 100% of the cash value. So let's just say for easy math, we accessed $100,000. You know, I don't know exactly what that final number would be, but it's $100,000. You can then invest that money that you access into something else. All right, so you can invest into something else. He talked about private placements. And these private placements, he said he knows of 2 that he's thinking of that are safe. We didn't go into detail on these investments. Okay, that'll be a future conversation. But he said right now they pay, depends on which one you go with, between 8 to 18%. Okay, 8 to 18%. It's a fixed rate, 8 to 18%, and it's a 5-year term. So you would take that, let's say it's $100,000, put it into a private placement, depends on which one you go with, and I'm sure there's some that are safer than maybe one's safer than the other. I don't know, I haven't looked at the investments, but 8% or 18%, let's just say it's those two numbers. So if you think about that right there, you pay no money out of pocket, you get an interest rate, you're paying a 3.5%, but you get 6 to 8%, and you're paying that back. So you're making 2.5% to 4.5%. But then you take cash value and you invest it and get 8 to 18% on top of that 2.5% to 4.5%. So my mind says that could be 20.5% to 22.5%. All right, now with that being said, I've learned in life when someone says an actual percentage, I'll knock a little bit off that because sometimes things happen, you don't get quite everything, or maybe you have a couple months you're not getting it, so maybe it's not quite as good as what it sounds like, or maybe it is. I don't know. I've never done this before. All right, so he said they have a 5-year term. At the end of 5 years, you get your principal back. You get the money back that you invested $100,000, because that private placement, they use that money for something else for those 5 years, and then you get it back. All right, so then you get the money back, you do it again, or you pay off the loan. So a couple different things. So when you get that premium back, that lump sum back after 5 years, you can put it back into a private placement, or you put it back into your collateral account. All right. I asked him, all right, what's the risk on this? And he says there's almost zero risk. And I said, come on, there's always a risk. And he says one would be if the life insurance company that you got your life insurance with went out of business. But he said he eliminates that risk by only utilizing life insurance companies that have like an A+ rating. They've been in business for like 100+ years and never have defaulted on payout or all that kind of stuff. And I know you got life insurance, you got insurance companies that have been around for hundreds of years, 100 years, let's say, not hundreds. All right. So that's what he said was the main one. I look at it as the second risk is you've now taken a loan out from a bank that somehow probably goes on your credit report. If you're trying to get a mortgage, it goes on your debt to income ratio. Okay, so that's another risk right there. But if you're like me and you're using non-QM lenders, is that per se a risk? Is that a risk? All right. The other thing we talked about a lot of different things. And we were talking about the whole life or the index universal life insurance. I'm going to get back to that, no money out of pocket. These, you pay the premium. You can pay the premium. If you have cash, whatever that cash is, you could pay the premiums up front. So you're not paying monthly. Maybe you get a small dollar amount. Maybe you get $50,000 or $25,000. You pay it up front, whatever that is, and you get a 6 to 8% dividend rate, just like the other one, 6 to 8%. But then you get the collateral account, you get the tax savings, there's no tax on it. And he brought it up with this one, which I think pertains to the no money out of pocket, because I like the no money out of pocket, okay? With that collateral account, let's just say it's $100,000, I think I could take that money and invest it however I want to. I could take that money and build a tiki hut. I could take that money and rehab my pool, I think, tax-free. But then I do have to pay it back, so that's, I'm spending that money, that's a toy. But I think I could, as an example, buy a rental property. Let's say I had access to $100,000. I could pay cash for a $50,000, $60,000, $70,000 house, rehab it, go to my non-QM lender, refinance it, get the money back, put the money back in the collateral account, and do it again. Do it again. Do it again. Something like that, okay? I'm not saying I'm going to do any of this. I'm looking for feedback. I'm looking for information for you guys. Somebody out there that watches this, hopefully, will know something about this. Is it a scam? I've heard about it. I've heard wealthy people do this. I don't think it's a scam, but I think you got to be careful, okay? What do you think? What do you think? Are you intrigued by this like I am? I'm hot today, too. I don't know if I'm coming down with a cold or I think I have allergies. I haven't gotten a cold in years. I do get allergies at times. And I have the solution to that. I think I've shown it one time on this channel. Sinus Buster. I'm going to go use some Sinus Buster when I finish this video. And it's about lunchtime and I'm hungry. And I'm thinking out loud here. No money out of pocket. Life insurance. Bank gives me a loan. I now have $100,000 life insurance. I pay the bank rate, interest only 3.5%. I make 6%, so I pocket 2.5%. Okay, that's no money out of pocket. But then if I got a cash value, the bank has paid the premiums in full, so whatever that policy is for, $100,000, $50,000, $25,000, it's paid in full. It has a cash value, and let's say it's that $100,000, $50,000, $25,000. Maybe they give me 80% of it, maybe they give me all of it, and I take that money, put it into a collateral account, and I invest it either into a private placement with a guaranteed rate of return or potentially into another rental house, where when I buy rental houses, my returns are usually 12 to 15% up to 30% when I buy it. Not after rent increases, but when I buy it. It's getting a little tougher to buy rental properties with that great return, but I've been successful so far, so we'll see if I can do it again. So anyway, I'm going to wrap this up. It's gotten long like all my videos do. So what do you think? Have you done this before? Do you know anything about this? Do you have any feedback you can give me? Any feedback at all? I do appreciate it. Remember, I'm not a financial advisor. I'm like you. I am learning about investing. Meanwhile, I'm financially independent. So catch up to me. Everyone, catch up to me. You can do it. My mastermind group is going to catch up and pass me. I guarantee it. I can't guarantee anything, but I think they will. All right, so you catch up to me. If I can do it, you can do it. I'm blue collar. I was a blue collar worker all my life. I'm still blue collar. So, all right, good enough. This is getting long. Mazske is signing out.